My friends had a subscriber ask, hey, what happens if you leave California midway through the year and you do a Roth conversion when you're in Florida? You relocate to Florida as opposed to California. What happens to your taxes? And I said, man, I don't know. And he emailed me a publication that the state of California provides, which I'm going to go over right now. It's actually incredibly helpful, very, very helpful. And there's going to be a lot of wonderful information in here. If you are becoming enchanted with California politics and you're thinking about moving to a more freer state, this is one publication that you need to familiarize yourself without question, because this is great. So sign up at the, don't forget to subscribe to Heritage Wealth Planning, comment, thumbs up, the whole thing. And I'm telling you, this is from a subscriber of mine who just, again, he said on his email or through the YouTube chat, he's thinking about relocating to Florida. He's thinking about doing Roth conversions. He doesn't know how it works when it comes to tax status if he's a part-time resident of the state of California, if he's doing a Roth conversion, because Florida doesn't have a tax. So let's dive into this. It's pretty interesting. So, hey, by the way, if you go to Heritage Wealth, you're not going to be able to see my mug when I go to the PDF. It simply won't. It doesn't record on a PDF file. Sometimes don't know why. So if you're wondering where'd that guy's face go, it's in the background, which is probably more beneficial to you anyway. You don't want to see this big mug with a Patriot shirt on, do you? But as always, if you go to Heritage Wealth Planning and you want to sign up for my email list, you'll get this pop-up. I think I set up where it takes 10 seconds, maybe 20 seconds for it to show up as a pop-up on Heritage Wealth Planning, and you type in your name, your email address, and your state, get the free book, and you will have subscribed to my email list. I send 3 emails a week, maybe 4 a week, so definitely do that. So, all right, so again, it's heritagewealthplanning.com. All right, let's go to this now. This is publication 1031 from the state of California, the Franchise Tax Board. Not sure why they call it a Franchise Tax Board, but there you go. All right, so basically we're going to go down this. How many pages? Because nothing is 14 pages. All right, so we're going to go down here and just read some of the stuff that's of interest to me. You got all these different, it's just a wonderful chart here. So let's go on to this. It is important for California income taxes purposes that you make an accurate determination of your residency status. Residency is primarily a question of fact determined by examining the circumstances of your particular situation. The publication provides information to help you determine whether you are a resident of the state of California, whether your income is taxable by the state, and whether you need to file a California tax form as well. The FTB is the Franchise Tax Board, which issues written advice on whether a particular activity or transaction is subject to tax under the California law. So I almost didn't look at this as like it's not a franchise. But don't let the FTB dissuade you from reading this, even if you're not a franchisee. It doesn't matter. In general, California residents or part-year residents determine their California tax by multiplying their California taxable income by an effective tax rate. The effective tax rate is a California tax on all income as if you are a resident for the current tax year, divided by that income. The method ensures that non-residents pay the correct tax on their California-sourced income and does not tax non-California sourced income. We're going to talk about that here in just a second. And they talk about the basic requirements, and they talk about the gross income and whatnot. Registered domestic partners. So that they say RDP quite a bit here, and I assume it's same-sex couples married under the current law. I don't know, but they were saying under California law, RDPs must file their California income tax using either married RDP filing or married RDP filing separately. So RDP is as similar as being married. They're just saying you're registered domestic partners. I don't know if that means you don't have a marriage certificate. I don't know. But they're saying registered domestic partners are the same as married filing jointly or married filing separately. However, they determine RDP. I just don't know at this stage. It's not relevant anymore because the Supreme Court has not ruled on that. All right, which form to file? Residence. If you are a full-year resident of California and you meet the basic filing requirements, you need to file a California income tax return 540. Non-residents. If you are a full-time non-resident of California in 2018 and you meet the basic requirements of Section B, you'll need to file a long or short 540 NR. All right. And so we're going to talk about some of the exemptions and whatnot. If you're active duty, blah, blah, blah. All right. Who are non-residents and who are residents? And this is critical important. A resident is any individual who meets any of the following: present in California for other than a temporary or transitory purpose, Domiciled in California, but outside California for a temporary or transitory purpose. A non-resident is an individual who's not a resident. Okay, that makes sense. I live in Georgia. I am not a resident of California. Thus, I do not need to file, unless other options happen, a California income tax. A part-year resident is any individual who's a California resident for part year and a non-resident for part of the year. And we're going to talk about that. All right, safe harbor is available for certain individuals leaving California under employment-related contracts. They go into all that. I'm not going to talk about that here. They're basically saying you got to transition out of your military. You got to transition to a South American mining company for a couple months, even at 18 months. One case, they say you're transitioned to Japan for 3 years. You are no longer a resident in that case. All right, so guidelines determine residency. So just if you still maintain a home in California and they're transitioning you out for a certain amount of time, most likely you're still a resident. But in this case, they use an example of Japan. If you're gone there for 3 years, you're no longer a resident of California. Guidelines for determining resident, you have to look up that yourself. The underlying theory of residency is that the resident of the place where you have the closest connections, and even if you live in New York, I'm telling you, this is critically important. New York is notorious for chasing you down, even if you've been gone for a couple of years, for getting income tax and even estate tax. The following list shows some of the factors you can use to help determine your residency status. Since your residence is usually the place where you have the closest ties, you can compare your ties to California with your ties elsewhere. And using these factors, it is the strength of your ties, not just a number, that determines your residency. This is only a partial list. I'm telling you, they had a guy in his 2011 or something like that who was residing full-time in Connecticut. He had a condo there full-time in Connecticut, and he was commuting into New York City to do his work. I think he was like a Wall Street guy. Long story short, he also had a part-time residence in Albany. I can't remember, maybe Saratoga, something like that. But anyway, he had a part-time home there. And New York State said, you are basically a New York resident and you need to pay income taxes in New York. And if I recall correctly, he did not get the tax. He had to pay it in Connecticut too, because they said, no, we think you have to pay income taxes. I can't remember the whole story, but he had to pay twice. And I'm drawing a blank exactly the circumstance, but you're sitting there thinking, the New York State, he had to pay the full, and I could have sworn the Connecticut, he had to pay the full too. It was horrific. I just never forget. And he's like, dude, I live in Connecticut. And they said, sorry, you also live in New York. He was like, how can I live in both places? And New York didn't care. They just want the money. All right, so factors to consider for your domicile: amount of time you spend in California versus the amount of time you spend outside. Location of your spouse or registered domestic partner and children. Location of your principal residence. State that issued your driver's license. State where your registered vehicles are registered. State where you maintain your professional licenses. State where you're registered to vote. Location of the banks where you maintain accounts. Location of your medical professionals. Interesting, isn't it? Let's see. And location of your social ties, your church, your professional associations. Location of real property and investments. That's a big one. And permanence of your work assignments in California. So if you think that California isn't on you like white on rice to determine if you're a resident in California versus Nevada, I highly suggest you rethink that. If your doctors, your churches, all these things are in California, unless you have significant ties to Nevada other than just a condo in Laughlin or whatever it was in Nevada, California is going to be on you and they're going to want their money. And I hate to say their money because it's not, but yeah, fight them and you're going to lose. Generally, your state of residence is where you have your closest connections. And of course, we talked about that. If you leave your state of residence, it is important to determine if your presence in a different location is for temporary or transitory purpose. You should consider your purpose and length of your stay. So I'm not going to go into coming into California, but we are going to go to leaving California. All right, because this is the big one. And any individual who's a resident of California and continues to be a resident when absent from the state for a temporary or transitory purpose. An absence from California under an employment-related contract for a period of at least 546 consecutive days may be considered an absence for other than a temporary or transitory purpose. Again, we then see safe harbor like I was just talking about. Example. Until September 2018, you are a resident of California. At that time, you declared yourself to be a resident of Nevada, where you have a summer home. You continue to spend 6 or 7 months each year at your home in California, which you have retained. You spend only 3 to 4 months in Nevada and the rest of your time traveling in other states or countries. You transferred your bank accounts. However, you continue to maintain your social and business connections in California. You want to take a guess what California thinks? Your declaration of residency of Nevada does not establish residency in that state. Your closest connections are to California, and absence from California is temporary. You are therefore a resident of California and are taxed on income from all sources. Example 2. You and your spouse are California residents. You accept a contract to work at a firm in South America for 16 months. You lease an apartment near the job site. Your contracts state that your employer will arrange your return back to California when your other contract expires. You and your spouse and your children will remain in California during your time that you are in South America. In your home that you own, by the way. You maintain determination. You retain strong ties to California because your children are there, as is your home. Your intent is to return to California, and thus you are taxed on all income from all sources and include income earned in South America. Number 5, you receive and accept a permanent job offer in Spain. You and your spouse sell your home in California, pack up all possessions, and move to Spain on May 5th, 2008 with your kids. You lease an apartment and enroll your children in school in Spain. You obtain a driver's license from Spain and make numerous social connections in your new home. You have no intention of returning to California. In this case, you are a part-time resident. Through May 4th, 2018, you were a California resident. From then on, you are a non-resident. All your income while you are a resident of California is taxable in California. While you are a non-resident, only income from California sources is taxable. So in this case, like my man who's moving to Florida, that would be applicable to him and probably many of you all as well. Example 6, you are a resident of California. You accept a 15-month assignment in Saudi Arabia. You put your personal belongings, including your car, in a storage in California. You still have your California driver's license and are registered to vote there. You maintain bank accounts in California. In Saudi Arabia, you stay in a compound provided to you by your employer, and your only times there are through your work. You will return to California. Well, that's obvious what's going to happen here. You'll be considered a California resident for sure, and your income from all sources is taxable in California. Now, this is the 3-year rule in Japan right here. You are a resident of California and a single taxpayer. You accept a 3-year assignment in Japan. Your assignment in Japan covers the period from 2017 through 2019. You rented out your residence and put your truck and belongings in storage. You maintain your California bank accounts, driver's license, voter registration. You have less than $200,000 of intangible income during each year. Upon completion of your assignment, you intend to return to California. In this case, you meet the safe harbor rule and are non-resident during your absence because you've been there for so long. All right, now here's what's interesting. Income taxable by the great state of California. Obviously, if you're a resident of California, all income is taxable. Non-residents of California are taxed only on income from California sources. That's it. Non-residents are non-taxed on pensions received of non-residents of California are not taxed on pensions as of December 31st, 1995. Part-year residents, the big one, are taxed on all income received while a resident of California and only on income from California sources from a non-resident. So they're going to give some examples down here. Wages. So here are some examples. Example 1, you're a resident of New York working temporarily in California for New York Corporation. Your income earned for services performed in California has a California source. As a non-resident, include this California source income on Schedule CA 540 non-resident, column E. So you have to file that because you earn income while you're a New York resident but working in California. Example 2, you are a California resident. As a representative for your employer, you spent 2 weeks in Georgia to give training. You are paid by a Georgia corporation while you're in Georgia. Because you are still a resident of California, you are taxed on all income regardless of sources. Now, here's where it's going to get interesting. You are a resident of Texas and have interest from a California bank account. Because you are a resident of Texas, the interest has a source in Texas. The interest is not taxable by California. All right, because you're a resident of Texas and the interest has a source in Texas. You are a resident of California, though, and have interest from a savings account in Oregon. Because you are a California resident, you are taxed on all interest regardless of sources. You are a resident of Montana and have dividends from a California corporation. Because you're a Montana resident, the dividends have a source of Montana in Montana, and thus you are not taxed by California. Pretty interesting, huh? But they're going to say, if we look down here, I think they say about, this is what I want to talk about, pensions. They also talk about lump sum distributions, and I think they also talk about income from a California corporation. Maybe it's here. Interest and dividends have a source of California. If I thought I saw it here as subchapter S in California that you received income from. Okay. I don't know, but there was a thing in there that if it's a California subchapter S and you received a dividend from it, I think even if you're not a resident, you had to pay tax, but I can't remember off the top of my head. It was around here someplace. All right, so here, pensions and KIOs. Distributions from employer-sponsored pension, profit-sharing, stock bonus plans, and other deferred comp arrangements are taxable by California regardless of where the services were performed. Non-residents distributions are not taxable by California if it's after 1995. Example 6, you were a resident of California when you earned your pension. You retired during 2018 and moved permanently to New Mexico. After becoming a resident of New Mexico, you begin drawing your pension. Since you're a non-resident, the distribution is not taxable because you received it after 1995. So if you're a non-resident of California, even if it's a California pension, it's not taxable. Example 7, you lived and worked in Ohio. You retired in Ohio and received your first pension check on January 1st, 2018. You moved permanently to California in July 2018. You became a resident in July of 2018. Your pension income received beginning in July of 2018 is taxable because California residents are taxable on all income regardless of source. So remember, you retired in Ohio and received your first pension check on January 1st, 2018, but you did not move to California until July 2018. You became a resident on July 2018. Your pension income received at the beginning of July is taxable, but the pension income you received before that is not because you were not a resident there. Lump sum distributions. Again, we're just going to talk about non-residents here. The lump sum distributions from a qualified plan or annuity are not taxable by California after 1995. However, lump sum distributions derived from a California source received from most non-qualified plans continue to be California taxable. You lived and worked in New York, you retired and moved to California, and became a resident. Prior to locating, you elected to receive a lump sum distribution from your qualified pension plan. You received the distribution after you became a California resident. The determination is taxable by California because California residents are taxed on all income. Here's where it gets interesting. You were a California resident and worked for a corporation in California. You moved to Ohio during 2018 and elected to take a lump sum distribution from your qualified pension plan. You received the distribution after you became a resident of Ohio. Since you are not a resident, you're a non-resident, the distribution is not taxable by California because you received it after 1995. You were a California resident and worked for a corporation in California. You moved to Ohio during 2018 and elected to take a lump sum distribution from your qualified pension plan, which you received when you were a resident of Ohio. Since you are a non-resident, the distribution is not taxable. Isn't that pretty interesting? So let's go with more examples. Let's see. You are a resident in Idaho. You are a resident in Idaho. You sold undeveloped real estate located in California at a gain. Because the property is in California, the gain is a California source income, and as a non-resident, you will pay tax. You are a resident of California. You sold real estate located in England at a gain. Because you are a resident of California, you are taxed on all income. You are a resident of Nevada. Your residential real estate located in California. Your property has shown a loss. You sold the property for a gain. Because the property is located in California, the gain is on the sale is taxable by California. Since property is classified as passive activity, the sale triggers the release of suspended losses incurred in taxable years. So if you're taking depreciation and now you have a gain and you're going to pay tax on it because it's a California source. Let's see. That's all I wanted to talk about here. Sale of stocks and bonds. If you're here's a couple good examples. All right, so we got you're a resident of Oregon and sell stock of a California corporation for a gain. Because you're an Oregon resident, it is not taxable. You're a California resident and sell stock of a Kansas corporation for a gain. Because you're a California resident, it is taxable. And then they talk about airline employees, all kinds of other things here too. So what I like, and they talk about foreign countries. All right, so what I like most on this is community property. Yeah, so I tell you, you got to know your community property stuff, my friends. That's a big deal. I'm not going to get into it here, but at the end of the day, California is going to tax you, according to this, on the income you received when you're a California resident. The income you received when you're not a California resident, California will not tax you. It's just that simple, unless the source of income, i.e. a California property, a piece of real estate in California. It's just that simple. So even if you own a company that is located in California that pays the dividends, if you live in Georgia, you're not paying tax on that. If you live in California and you own a company from Georgia that pays tax or dividends, you will pay tax. It's just literally that simple. So this guy, if he's moving from California to Florida in July of 2019, he should wait until he locates in Florida before he takes a lump sum distribution from his pension or does a Roth conversion. So that way he does not have to pay California income tax on that amount of money. I hope this is helpful. I thought this was incredibly helpful, actually. And I'll put the link to the show notes down here. So as always, leaving California, what's your taxes? If you know folks are in this conundrum, share this video. Don't forget to subscribe down below. And as always, if you like what you see here, comments, thumbs up, the whole thing. There's a lot going on for part-time residents, and you got to know the deal for sure before you make a mistake. So we'll see you next time. Thanks, guys.